The UK is a well-established market and has been in flux since the GFC and the vote in 2016 to lead the European Union Common Market, known as Brexit. The UK pound is depreciating against most currencies except the US dollar. The current interest rate is 0.5%, which is significantly lower than most world economies. Inflation is 2.44%, which is higher than the recommended 2% rate. GDP growth is 1.9% annually, and government debt is 88.3% of GDP. The UK's current account is in deficit, and they are a net borrower.
Currently, the UK boasts strong economic conditions domestically, the likes of which haven't been seen since pre-Brexit times. Britain's current inflation reflects its recent return to stability domestically, and various economic indicators suggest stable price growth in the immediate post-Brexit future. Similarly, Britain's unemployment rate has been consistently below the 5% benchmark for some considerable time, which is indicative of a strong Brexit economy. The economy's growth rate is also predicted to pick up after the poor growth seen during the news breaking of Brexit.
The United Kingdom and the European Union have an open trade agreement. This means that there are no tariffs when trading between countries and a freedom of movement exists. However, the EU and UK have agreed on Brexit to occur in 2019. Brexit will prohibit the free flow of people from the EU to the UK. In regards to tariffs, it was reported by The Balance that the UK won a custom union, meaning that no tariffs will be imposed on each other's imports. The UK's Treasury stated that post-Brexit, growth is expected to slow to 1.9% in 2019 and 1.6% in 2020. As UK have a flexible exchange rate and a perfect capital mobility, this will create an excess demand of foreign exchange, resulting in a decrease in the pound. This will create an equilibrium where interest rates remain constant and production has decreased.
Brexit has proven to be a massive disrupting event for the UK economy. Uncertainty in the UK's economic future has led to a highly volatile period while details in Brexit plans between the UK and the EU are finalised. Meanwhile, Britain's current inflation rate and consistently low unemployment reflect domestic stability to the Brexit news. However, after Brexit has been enacted in 2019, growth is expected to slow. The post-Brexit outlook is indicative of a value depreciation of the pound, an increase in the current account deficit, and a weakening of the British economy. Low interest rates, economic uncertainty, and a weaker pound represent key risks involved in investing in a current and future UK economy. Until such times as the Brexit negotiations are concluded and a full understanding of the new terms of trade between the UK and EU have been reached, we recommend holding off on any expansion of investment into the UK market. Instead, potentially looking towards the new trading partners the UK will have to forge relationships with as they benefit from a new source of trade.